Hello everyone, welcome to our discussion, Chapter 9. We're talking about tax credits. Now, just a quick reminder of what we mean by tax credit. Tax credits are those situations where, because a taxpayer has paid money for something, or deemed to have paid money for something, they get a credit towards their tax liability. This is not a deduction. It just doesn't change taxable income. It simply reduces how much tax you owe, and therefore how much you have to either pay, or influences how much you're going to receive as a refund. Because if a tax credit is refundable, it can create a situation where you'll get a refund. If it is non-refundable, then the option that can happen is it reduces your tax liability to zero, but it cannot create a situation where you are going to get more back. So these credits, each of the ones we're going to talk about here, are of great advantage to the taxpayer because they literally reduce how much tax they owe dollar for dollar. For a $500 tax credit is going to save you $500, as opposed to a $500 deduction that is going to only reduce your taxable income, and therefore only the percentage of tax you would pay on that taxable income. So let's jump in. First, credit. And again, we're talking about, and these are very much about Congress trying to get people to provide a tax benefit for things that they feel like are important, or that the people should engage in them. So the first one is for child or dependent care expenses. They expanded it to include not just care for children, but also for parents that may be your dependent, that need somebody to stay with them while you go to work. Okay, so this is for a credit for the cost of paying for child care or dependent care. So this is for payments for those, for household watching over, while you go to work. Okay, for qualifying individuals, so that you can be gainfully employed. And you will see that later on that there's a limit, meaning if one spouse is not making, having any income, then this credit is not going to apply, or is going to be severely reduced. So who is a qualifying individual? Okay, person under the age of 13. So it's not all children, because remember the child definition we learned earlier is older than that. But at age 13, the determination is that they should not need child care in the same way, and that they have to be dependent, or a dependent spouse that is older than 13 and incapable of caring for himself or herself. Okay, so there's an expansion to be maybe an elderly parent, or even your spouse who needs constant care at home. And it doesn't have to be at home. It could be anywhere. It could be, you could drop them off, any of those type of things. So what you're looking at is it's not for all of the money you spend on your dependent care. It's a percentage, and that percentage depends on that taxpayer on AGI. So this is a situation where it does phase out. It doesn't start phasing out till a fairly high rate of AGI. And it starts at 50%, and that percentage gradually reduces until it's zero, so that you don't get the credit if your income is too high. So you start with how much you spent, okay, but you only get a credit for a percentage. You never get credit for the whole amount you spent. Now, there's also some other limitations. Okay, so besides having to look at how much you spent for child care, you have a limit on how much child care could be counted. Okay, and the limit is $8,000 if you have one dependent under 13 being cared for, and $16,000 for 2 or more. Notice there's not a 3, there's not 4. It's $8,000 or $16,000. You have 6 kids, and the limit is still $16,000. Okay, so it's $8,000 for 1, $16,000 for 2 or more. So if you spent $24,000, you only get to count 16 of it. All right, that's how this plays in. If you paid and you had one child and you paid only $7,000, then the list limit wouldn't matter. It would only matter if you spent more than $8,000. Then it would apply, and you would only be able to use $8,000. And then the other limit. Okay, so there really is 3 pieces. How much you spent, the 8 or 16,000 limit, and then there is the earned income of the lowest paid spouse. Now, if you're single or head of household, then obviously that doesn't apply because, or I shouldn't say that. It still is limited to the income of whoever that lowest paid spouse is, or in this case, it's not a spouse, but the lowest the taxpayer. All right, so there has to be income there. So if there's 2 spouses, then you're looking at the lowest paid spouse. So if they have no income, you have no credit because that's the limit. If they have very low income, that could be the limit. That could be the amount that you have to use, because it could be less than the $8,000. It could be less than the amount you paid for the child care, right? And so that could be very problematic if one spouse is, say, self-employed and his business is not making very much money. They may be gone full time. They may be working all the time, but the business is not off the ground, and so their earned income may be very low, maybe $2,500 or something. That would become your limit if you spent more than that on you, and you figure out your percentage based on that. All right. So you've got the 3 things to consider. You've got how much you paid for the child care, the 8 or 16,000 limit, or the earned income of the lowest paid spouse, or the individual if there's just a single individual. We're going to take the lowest of those 3 to apply, and then take the percentage for the credit. Now, they did write into this a situation, what if we have one spouse who's working and the other spouse is a full-time student or is incapable of working for some reason, okay, then we use their income is kind of deemed $250 per month if they have one child, or $500 per month if they're 2. So if you've got a full-time student who's in school 9 months, say they don't go during the summer, and your 2 children, then you have their deemed income is $4,500. 9 months times 500, $4,500. That becomes their income. It's not put on the tax return. It's not taxable income. It's just kind of pretend. All right, we're going to treat them as if there was some income, so that when we use of our 3 limits, remember we have the 3 limits: how much we spent, the $8,000 to $16,000, or the earned income of that spouse who's a full-time student, who we're going to pretend, just for this credit, earned $4,500 for the year, the months they were in school. And then you take the lowest of those 3 and multiply by the percentage applicable. And here's the table that tells you what percentage, and you have it in the book, you can find it online, all right? And you see that it's all 50% all the way up to AGI of 125,000, and then just very gradually all the way up to over 400,000. The percentage is going down as the income goes up until you get to all the way to zero. So, just an idea of what this, some examples, single mother, so we only have one spouse, okay? She has AGI of 176. She paid $4,500. That's less than the $8,000 limit, so we're going to use the $4,500, not the $8,000, okay? And then we're going to look up her amount on the table, what percentage, using 176,000, right? So we go down here to 176,000. Between 175 and 177 is 24%, and that's how we got 24% times the 4,500. Now we have a couple that are married, FOIL joint return, 2 children, 11 and 6. Okay, they're both under 13. They both qualify. Okay, Tom has 41,000. She's a full-time. Katie's a full-time student with no income. They paid 6,000. Okay, so already this 816 limit doesn't apply because the amount they spend is lower than that. So we know that's what we're looking at. Or the income of the lowest paid spouse. Okay, the lowest paid spouse is Katie, 2 children, student for 9 months. Even though she doesn't have any income, we assume, okay, or pretend that she made 4,500, 9 months times 500. So we use 4,500 as the lowest of the 3, because that's lower than the 6,000 that they actually paid. Her income is the pretend income, I should say, and then we multiply that by the 50%. Okay. No, actually, this is just asking what amount will be involved in the calculation. But yes, they're well under the 125,000. So the actual credit, if it asked for the credit, would be 4,500 times 50%. And then Antonio is a widower, so he's alone. He has a son, age 4. All right. So again, under 13. His AGI is only 24,000, well below any phase out. Qualified child expenses of 2,900, but he got some help from an employer. If that's the case, we have to apply that or reduce the amount we spent. So any child care amounts that were covered by the employer or were taken out of your income to cover by your employer, either of those two situations will actually reduce. So we start with the $2,900 that they paid. We subtract out the $1,000 to get $1,900. That's going to be the lowest, right? The 16 doesn't apply, and his income is higher than that, so we don't have to worry. We don't have that issue with that. So it's the $1,900. And then we're well below the 50, the phase out threshold. So 50%, $950 credit. Okay, so he would apply $950 towards any taxes that were owed for the year. Education credits. These are also very common. Okay, and utilized by all kinds of folks who have students in their family. One's called the American Opportunity Tax Credit, and the other is a Lifetime Learning Credit. Notice that these are available for the taxpayer spouse or dependents. Remember, we talked about the importance of who is a dependent way back in Chapter 2. And this is a situation where that's real important when you have, say, for instance, divorced parents, when these kids get to college, who is it that child is a dependent of? because that's who is going to be able to receive this education tax credit. And it can only be for the spouse or the parent who actually can claim them as a dependent. Something to think about as you discuss that in agreement in separation agreements or divorce agreements. But once we know who the dependent is, then we can start working on the actual education credit. This is filed on Form 8863. So what are we talking about? This is a situation where we paid for dependent care. This time we've paid for tuition fees, books, required books, not just like fun books, okay, and some other related expenses that you may have, equipment that especially they've allowed things like computers or other things that are required by the school. Usually they've restricted this to those that participate in student aid, which is most schools, but there are a few out there that are for profit and don't receive financial aid, and technically they would not fit this criteria. So again, first of all, we're looking at how much we paid for these credits or for these expenses, and then the two credits are a little different. Okay, the American Opportunity Credit is 100% of the first $2,000 you spend, and 25% of the next $2,000. So the maximum is $2,500, and notice it's per student. So if I have two children, like I did many times, two kids in college at the same time, okay, then I could get it for each child separately. So I could get $2,500 for child 1 and $2,500 for child 2. Okay. The lifetime learning credit is calculated as 20% of the qualifying expenses, much lower percentage, notice, but a maximum of $2,000 for my taxpayer, no matter how many kids I have in college. Okay. So that is a limit over my whole tax return, not per student. And that's an important distinction. And I can't use both. I got to pick one, right, for each situation. Now, I could use it for different. So I could use, for instance, if I had one child that was qualified for the AOTC, I could use the American Opportunity Tax Credit for that one, and then for my other child who I have different, I could apply to the Lifetime Learning Credit because they didn't qualify for the AOTC, but it can't be for the same expenses. They both have a phase out, okay? You lose them if your AGI is too high, okay? So it starts at $80,000 for single, $160,000 for married filing jointly, so exactly double, okay? And they're phased out completely by $90,000 to $180,000. So basically, you're going to phase out between 80 and 90 if you're single, and 160 to 180 if you're married filing jointly. So this is how you would calculate how much is phased out if you're over the threshold. Okay. So this is kind of figured out by using the top threshold. You can also calculate it by using the bottom threshold. So a quick check on a calculation here, $2,900. Lifetime learning credit. Notice it asks lifetime learning credit. So we just go with the 20%. We don't know what the AGI is, so we don't know if there was a phase out, so it's just $580. Okay. This time, question number 2, we have $85,000, and we're going to look at the AOTC. So, same $2,900. Notice how much different it is if we can use the AOTC. The AOTC is only for the first 4 years of college, so it's obviously much more advantageous. So you want to use it if you can, but once you've got done 4 years, it's not available. And it has to be for full-time students, the other thing that sometimes trips us up. 100% first 2,000, 25% 900. Start with a credit 2,225. It's limited because we're over the threshold, and you see the calculation there. So the only credit is 1,113, basically half, right? Because we're halfway through the phase out threshold, phase out range. Raise the situation, 98,000, okay? Wants to claim the AOTC? No, can't do it, okay? Because we're over the top end of the phase out range.